The following is a presentation of TFNN. It is now time for Trade What You See with your host, Larry Pesavento. Now, Larry Pesavento.
Okay, folks, good afternoon. If you have any questions, it's 927-6648, and that's area code 877. 877-927-6648. Just a reminder, I'm going to be doing a webinar for my newsletter subscribers at 6:30 tomorrow. That's 6:30 on Wednesday, May 15th. That's 6:30 Eastern Time, if you have an interest in that. Also, Steve Rhodes on his show previously talked about the art of the charts that Tom O'Brien and David have come out with for TFNN. This is really something to take a look at, folks, if you like the Gartley pattern, because this thing really goes through and scans the charts and really does a tremendous job with the way it worked. I've only seen a few samples so far, but I am thoroughly impressed, and I've seen a lot of supposedly automated Gartley patterns over the years. But this one is really good, and the fact that it searches for over 5,000 of these to come up with the setups each day is really an amazing thing, in my opinion. So keep an eye on that for the future. Okay, the first chart that I posted into Tiger TV is the E-mini S&P. It's trading at around the 1632 level. This is what I was looking for today to complete the pattern, potentially making a new high around the 1633 to 1634 level. The Dow is still lagging, but the E-mini S&P is in what I call a really high probability of a time zone move and a time zone for a short side trade. So that's something that I think we should keep an eye on. The reason why I'm bringing that up on a short-term basis right now, because longer term, this market is beginning to look like it did in '07, only actually worse because of the fact that we've had some interesting news items happen this week in Barron's. I'm going to post it in here. You'll see that the headlines in Barron this week, this is from John Hoosman, who's one of the hedge fund people. It shows that every time the Dow had these really bullish things occurring, there was an article in the magazine for Barron's, and one was in 2000. The Dow topped then, and then it topped again in 2007 at 14,000, and now we're topping again at the 2013 level. But this one has some really ominous implications because of the longer-term pattern that's here in the Dow Jones. It's really it's an amazing statistic to see it when you take a look at this. I'm going to put in the Tiger TV the Dow Jones going back to when it first started trading back in, actually it goes back to 1896. It started trading actually, there was no Dow Jones back in the early part of the 18th century, latter part of the 18th century, around 1792 is when they first did the first stock trade, I believe, under the buttonwood tree there in Wall Street. But the real trading was beginning after the Civil War, after 1876, 10 years after the Civil War. And then since 1896, we've had some, tremendous moves in the market, and they've been, really, really dramatic. When you look at this chart and you go back and look at the crash of 1987, you'll realize what a small move it was in the whole picture. It was really amazing. The crash of 2007, 2008 was far worse. But what's interesting about this pattern is the fact that each of these lows that it hit on the major basis, this is a monthly chart, folks, going back over 100 years, and it shows how it hits these numbers, of the Fibonacci sequence that we look at, 618, 786 on retracements, and 1.27 and 1.618 on expansions, and that's telling us, that we're looking at something that could have, tremendous implications on a, very, very, long-term basis, and we need to really focus on that, in my opinion, because it has a tremendous amount of implications for your 401ks and things like that. It's really it's really quite amazing. Now I'm going to go over and talk about the Russell because it is making the same pattern that it made in 2011 before it had a bid correction. We're having that 3 drive to a top pattern, just like we're having in the Dow Jones Industrials. And so all of this is, starting to fit together. And we're over these major astrological things. We had the new moon and solar eclipse on Friday, and then we have these astro things. The last one, I believe, ends today, and it will be interesting to see, how the market, responds, to that particular set of cycles. Now, there's a chance that this could be just like 2000, and the market continues to go up for another 6 or 8 months. But whether that happens or not, still remains to be seen. It's still, still a little early, and we have to be able to decide, whether it's going to be a longer-term move or not. If you'll give me 1 second here, I wanted to post a chart. One of the guests that I'm going to have on very shortly is Rick LaRusso. Rick is an old-time friend of more than 35 years, and he is a technical analyst for Morgan Stanley. He does a lot of work on Fibonacci, and he sent me a long-term daily chart going back about 18 months, and it shows the relationships of the Fibonacci numbers, to where we are right now. But what's interesting is that he also points out this reversal pattern that we're looking at potentially coming in on the S&P and the NASDAQ and the Dow Jones and the Russell. It also, the same pattern is occurring in the French market, the CAC market, which is, it's not nearly as big as ours by any stretch of the imagination, but the pattern is still there. And that's what's amazing is the fact that we've had this pattern, occurring just about, everywhere, across the globe. And that's what is really amazing. I'm going to point this pattern out to you because I want to spend a little time, more than as much time as necessary, to show, what this pattern really is. And it's quite important because it shows I want to make sure I get this in here. There we go. And this is the French market. It's doing exactly the same pattern that we're having in the Dow Jones, and it's the same pattern that we're having, in the S&P. It's the same pattern that we have in the NASDAQ. I mean, it's just everywhere across the board, and that in itself would be enough to, actually, scare you, a great deal, I think. Now, the speculation, is all about money management and stuff like that, and what we really need to do is, look at the overall picture of where the money's going in this market. And there was an interesting article from Merrill Lynch this weekend that caught my attention, and that is it shows that the amount of margin debt that is out there is actually increasing at a very strong rate, too. We're higher than we were in 2007. We're much higher than we were in 2000. In other words, people are borrowing more and more money to buy stock, and that also has negative implications. So you put all this stuff together, it's really interesting to see what will happen here, very, very shortly. So we're in a point now where I think we're within days of what I think will be happening. As a matter of fact, if this one doesn't work, I'm probably going to go back to using point and figure or something like that, because I have not seen everything set up like this since we've had the bottom, which was in March of 2009. That's that's the main thing that we're looking at when we watch this. Now, when we're measuring, the volatility in this market, we look at the VIX index, and if we take a look at the VIX index, you'll notice that it's making the 3 higher bottoms, which is the first indication. There's a small 28-day cycle that's also been in here. So the VIX index coming in around this $12.25 per share on the VIX index should be, I don't think it's a per share. I think it's just an index. So it's 12.25. But if we close below 12 on the VIX index, I will certainly be wrong, and we're probably going to be making sharply higher highs down the road. That's what my opinion will be on the market. I really feel really strongly about this. I've been bearish for a while. I haven't been bearish over the last couple of weeks because it broke out and it had to go to the next level. and that's what it's been doing. It's been expanding up to the 1.618. But all this is done now. I mean, all the patterns are finished. It either stops right here, or there's this thing is going to be like 2000 and in 1999 and 2000, and it's just going to keep going up, up and up and up. But believe me, markets that go up like this, they come down very badly, folks. That's historical. You can go back and look as far as you want to look at them, but frankly, that's how they end. They always end badly. This is not a parabolic move like we had in 2000, but they still end the same way. Nothing goes up forever, and we left a gap on Christmas Eve, way down there, another 20% lower than where we are now, and actually about 15% lower. And so that gap will be filled sometime in my lifetime. If God willing, I'll be able to, do the other stuff. So we'll see. Okay, so we will take a look now at the Dow Jones on a very long-term basis. I wanted to show, the pattern. Before I do that, I wanted to give the transportation, because the transportation index is doing exactly the same thing that all the other markets are doing. It's making this big ABCD pattern, with the 3-drive pattern, at the same time. And so it's telling us that, we are at some type of a major top within a couple of days of where we are right now. So that's my opinion of the market. Now, believe me, folks, this is my opinion. And sometimes I get on my soapbox and I get a little bit too strenuous, but this time I'm on the same soapbox that I had in March of 2009. It was very difficult to buy any stocks in March of 2009, but I really felt that was going to be, the mother of all bottoms for a while, and in fact it was. But to get anybody to buy stocks at that time, you certainly wouldn't be able to do that. Now, if you wanted to be really conservative, I'm going to put a long-term weekly chart here of the NASDAQ going back to 2000. And all you have to do, if you want it to be, if you want to get out of your stuff, all you have to do is to put your stops under not last week's low, but the week before last. Go back 2 weeks, find out what the low was. That low in the S&P on the S&P cash was around 1580. That was around 1590 in the futures, as I recall. And so that's the main thing that I would be watching, because if we break that, that would be similar to what happened in 2000, where we broke those lows of the last 2 weeks, and then we headed down, and we gave back more than 85% of the move, and then we made another 3-drive pattern into October of 2002. Remember, during 2001, after we had the 911 incident, the market really didn't bottom until 2 years later. We're going to take a little break here. When we get back, we'll talk a little bit about gold.
Daryl Martin coined the phrase diagnostic trading, and we're happy to announce that his diagnostic box spread analyzer has finally been released. The Diagnostic Box Spread Analyzer helps you easily identify the best box spreads on Nadex in seconds, plus you receive access to the diagnostic deviation levels, as well as step-by-step training videos teaching you how to trade Nadex spreads so you can quickly master the mechanics of this simple yet powerful trading instrument. By pulling live data from the Nadex exchange, the Diagnostic Box Spread Analyzer does all the math for you, calculating risk, reward potential, distance to break even for both outright spreads and spreads used to hedge the underlying market. Visit the front page of TFNN.com today to get your 2-week free trial to Daryl Martin's Diagnostic Box Spread Analyzer and gain access to the valuable information it can provide when trading the Nadex box spreads. You take a hands-on approach to managing your investment strategy. You're always looking for the next trading opportunity to magnify your perspective. Direction Shares connects sophisticated traders with a powerful array of ETFs from a wide range of asset classes. The markets may go up and down, and you want tools for both sides of the trade. Discover how we can help at DirectionShares.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction shares. To obtain a prospectus or summary prospectus, please contact Direction shares at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors employing dynamic strategies. Investors in the fund should understand the consequences of seeking daily investment results, understand the risk of shorting, and intend to actively monitor and manage their investments. Distributor Foreside Fund Services, LLC. McEwen Mining is a high-growth, mid-tier producer in the Americas with a market capitalization of $1 billion. Experienced mining executive Rob McEwen, as chairman, CEO, and president, owns 25% of the outstanding shares of McEwen Mining and has put in place an ambitious business plan with the goal of qualifying for inclusion in the S&P 500 by 2015. With $70 million in cash and liquid assets as of the end of 2012 and completely debt-free, McEwen Mining is poised for growth. Production in 2013 is forecasted to grow at 24%, reaching 130,000 gold equivalent ounces, and over the next 3 years, McEwen Mining projects that their production will increase to 290,000 gold equivalent ounces, almost a threefold increase from last year's totals. If you'd like to find out more about McEwen Mining, click on their banner on the front page of TFNN.com or check them out on the NYSE or TSX under the symbol MUX. TFNN is excited to launch our brand new software charting program, The Art of the Charts. In collaboration with Tom O'Brien and using his best-selling book, The Art of Timing the Trade, Your Ultimate Trading Mastery System, David White has programmed an outstanding piece of software that will complement any trader's methodology. Using this first-of-its-kind software, Art of the Charts allows you to scan for Fibonacci formation setups, including Gartley's, butterflies, ABCs, and much more. Art of the Charts is designed to help you when scouring the market for stocks just beginning to form the trading patterns that many investors spend days, weeks, and even months searching to find. As part of our introductory pricing, we're offering licenses available at only $59 per month. We're so confident that you'll love this new outstanding piece of charting software that we'll even give you a 30-day unconditional money-back guarantee. Don't miss out on this incredible new piece of software. Lock in your low price today by ordering your copy at TFNN.com.
Larry takes your phone calls now. Toll free at 1-877-927-6648. Internationally at 727-445-1044.
Okay, we're back, folks. And I wanted to talk a little bit about the gold market here because we are at a really critical level. Friday, we hit the 38% retracement from the low. On April the 15th, we rallied well over $70 an ounce, $160 an ounce, up to the April 25th high, and then we came down and we made a 382 retracement so far, and that's what we're looking at right here as making that retracement, and it held so far at the 382 level, which was at 1420. We've been going sideways today. We backed off a little bit. We rallied $30 on Friday, and we backed off about 78% of that. So it's holding up relatively well. Silver's actually up on the day today, which is the first time that silver has actually gone ahead of gold on a relative basis for a while. But silver's so much harder to trade than the gold is, so it's a lot more difficult. We got a call from John in Philadelphia. Are you there, John?
Good morning, Larry.
Good morning. How are you today?
Very well, thank you. Say, Larry, I was interested to hear you speak of gold, and I thought I would dovetail with that by asking you the question about the Aussie dollar. Interestingly enough, the Aussie dollar has been trading lower in the past number of weeks, along with the gold market. I've got my own views of what may be developing in the Aussie dollar on the weekly. I wanted to ask, when you look at it, if you see anything setting up specifically with a possible major low forming somewhere maybe down near 96 before turning up to head higher. That's kind of my thought, wondering what you see.
Well, it could easily the 786 retracement, John, and the 1.618 expansion comes down at the 98.45 level. So we're 100 pips away from there, and we could easily go to 96 again because, we were there, back last May. And so, we're in the middle of May where we bottomed last year, but right now we're completing a major Gartley pattern at this 99.70 level. We're trading a few ticks under that right now, and that's really what we're looking at that point. But I agree with you that I think we're very oversold. We've been down 10 days in a row. The last time we had this, we had a rally of a couple hundred pips. But on a long-term basis, this Australian dollar is probably going to go lower because the highs that we made during July and September and January of this year and also April this year, they were all 786 retracements.
Yeah.
And so that's why it makes us look like we could be heading for lower territory.
Can I ask you about this feature? I'm looking at your daily chart that I see in the den. As I go to the far left of that chart, I see the all-time high back in 2000. It was about 110, and within a brief three-month span, it declined sharply down to 94, and has since been in a sideways pattern. And call me crazy, since that high July 11 to October 11, I see what appears to be lower highs but higher lows, perhaps a consolidation poised for a bottom, and then one more rally up to 110. What do you think?
That's certainly possible. Now, I posted into Tiger TV that long-term weekly chart on the Australian dollar, and we've broken below that low today. That low came in at, 99.70, and we have, we're trading at 99.45 right now. So right now, it certainly looks like it is breaking down, and it has a potential, to come all the way down to 78 without any trouble on the long-term weekly chart. Now, I don't trade off of weeklies, but it certainly could do that without any trouble at all. That's the way it looks like to me, anyway.
Gotcha. Very good, Larry. Thanks for those thoughts. I appreciate it.
Well, John, I want to thank you for that wonderful trade you gave us 2 weeks ago Thursday on the gasoline futures when it was trading around $2.70 a gallon and exploded to the upside. So that was really a great one. I appreciate all the work you do. You do a lot of hard work, and I know you're a professional at this, but the fact that you're willing to share it all is what's really important. So thank you very much from all of us here at TFNN.
My pleasure, Larry.
Okay, thanks a lot, John.
Good thing. Bye.
Okay, getting back to the gold market. I am bullish gold right now as long as we stay above the 14.17 per ounce, and that's because it made that 382 retracement. Since gold bottomed on April the 16th, we've only had one other retracement that was that good, and that was a 382 retracement right after the April 15th one, and now we've had this. We've got to take a little break. We'll be back, and we'll be talking about some bonds and some notes when we get back to that.
Tom O'Brien's daily newsletter, Market Insights, gives you Tom's daily commentary on the broad market, including the Dow, NASDAQ, and S&P, plus specific trade recommendations. With Market Insights, nothing is left to guessing. With the market at record levels, volatility is here, and now is a perfect time to take advantage of a 2-week free trial to Tom O'Brien's daily newsletter, Market Insights. As recently as March 26th, Tom advised his subscribers to liquidate their 4 short-term equity holdings, closing out all 4 positions for a combined 15.9% profit. And on April 1st, Tom advised his clients to sell their longer-term position in AIG warrants, locking in more than a 40% profit in just that one trade. If you'd like to see the kind of newsletter Tom O'Brien sends out to his subscribers each morning, then sign up for your 2-week free trial to Market Insights today by visiting the front page of TFNN.com. Has the current market volatility continued to stop you out of trades when the market spikes against you? Now is the perfect time to open up an account with Nadex. Nadex, the North American Derivatives Exchange, is a brand new, completely regulated Chicago-based exchange, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their completely free trading platform, which also features real-time charts and full customization capability. One of the advantages of trading with Nadex in volatile markets is that your risk is always capped and you have the ability of keeping your trades open even when the market spikes against you. Nadex is completely brand new with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's Nadex.com. Or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors.
Recently, Basil Chapman has had some outstanding trades in his newsletter, The Opening Call. Each morning by 9 a.m., Basil uploads his newsletter to the TFNN servers so that his subscribers can access his expert trading advice. Basil gives his take on the direction of key indices and updates any active trades that his subscribers are currently in. Just recently, Basil's subscribers closed out a short position in Chipotle Mexican Grill, CMG, for more than an $86 profit per share, over a 20% gain in just one position. If you'd like to try out Basil Chapman's newsletter, The Opening Call, then visit the front page of TFNN.com and click Trading Newsletters. There you'll find Basil's newsletter, The Opening Call, where you can request a free sample copy. Also, don't miss Basil's program, The Tiger Technicians Hour, Monday through Friday, 11 a.m. Eastern, on TFNN. No matter where you listen to TFNN programming, we want you to know you can always access your favorite shows on demand through TFNN.com. TFNN airs live programming every market day from 9 a.m. till 6 p.m. Eastern, and you can view each program by accessing Tiger TV through our homepage. We even have an easy link for all mobile devices, including iPhones and iPads, located at the top right-hand corner of the TFNN homepage. You can use your smartphone to view Tiger TV, but if you don't have a mobile connection that can keep up with streaming live video, then you can simply visit TFNN.mobi in the browser of your smartphone for live streaming audio of all of our programs. The mission of TFNN is to educate our audience directly and interactively through our interactive website and radio call and talk shows. TFNN is able to teach all levels of investors the technical skills needed to trade in today's marketplace. In order to get the best information possible, TFNN has assembled the most respected financial minds in the country to provide the most current news and comprehensive advice available. TFNN.com. Educating investors. This segment is brought to you by TFNN. Test drive all the newsletters for free at TFNN.com.
Okay, we're back, folks, and I had a question that there's a lot of things that people talk about that we could easily make 1650 in the S&P, which is another, 30 points higher. We could certainly do that. I mean, I don't know if you remember this, but in May of 2011, when Osama bin Laden was found, and they basically when he was killed, found and then killed in that order. I think that's how it went. But anyway, on that day, that was happened in the middle of the night over there, which was early in the morning for us, and it literally made the market jump a great deal. And that was the high from May of 2011. We could certainly move another 30 points in the S&P without doing too much. The thing is that I'm watching is that all of the numbers and all of the patterns that I'm looking at in all of the markets, I'm looking at France, London, Germany, United States, and in the United States I'm looking at the Dow, the Russell, the industrials, the utilities, the S&P 500 cash. They all come together right around the same time and price up in this area right here. I posted a chart from Ricky LaRusso earlier showing these Fibonacci relationships, and they're related to the Astro relationships that are there right now. So that's why I think, this is where we are in the market. So, that's my opinion. I could be wrong, I'm wrong a lot, but in 2000, the market went straight up for another 3 months from January to March, then had the big thing. I have not stood in front of this market for the past several weeks, ever since, I believe, April 18th, I believe, was the last time I took a nibble at it from the short side, and I'm trying again today I put that into the newsletter. I think also that this was a very important time. This Barron's article that's in there has really long-term implications on the market, as does the margin debt that's in there. You know, people are borrowing more and more money to buy stocks, which, believe me, that's not a good thing. Leverage is a thing that can work both ways, and it's a sword that has two edges, and you've got to be extremely careful, because that would be the thing that would be able to do this. I'm not risking more than 6 points in this S&P trade. So at 1632, you know, above 1638, I would say goodbye. You know, sayonara, I'll look at something else. But that's the way it looks to me right now. And it's just a pattern. You know, I'm not sure which ones work. Nobody does. You know, they're just patterns. That's all they are. Sometimes they work. You know, sometimes they don't work. And that's, you know, what the bottom line is. You just got to be able to stand in there and protect yourself. That's really what you're looking at. Now, I want to move over to the bond market, because I've been, you know, looking for a major tops in bonds for a long time here. We've had a major head and shoulders pattern that completed just about perfectly. We were wanting to sell at the 150 level. We missed that, folks. That missed it by about eight ticks, $250, and now we're starting, you know, a move to the downside. I believe higher interest rates are coming, and they're probably going to come very quickly. And if we go below 141 in the June Treasury bonds, it's going to be very quick. They'll come down. You could get bonds to come all the way down to the 124 level. That's $17,000, and it still would be in a, you know, a strong uptrend, because this market has not done anything but gone straight up, you know, since 1980. You know, that's when interest rates were, you know, 13% for T-bills, and you know, that was the bottom of the bond market, and it was the you know, the start of the largest bull move that we've had. It's been the longest lasting bull move, I think, without any major corrections of any market that we've had in my time of trading. That's you know, what I'm looking at now. I wanted to switch over to the short-term timing for the bonds, because we have some really lovely things coming in on the hourly chart. And the reason why I'm bringing this up is, if you remember when we were watching Apple on its way down to the 394 share level, we went from a daily, and then we went down to a 60-minute chart, you know, to basically look to see where we were expecting a bottom. Well, the next level of support in the Treasury bonds comes in at 143. And right now we're about 1.5 points away from that level. So this is something that, you know, we're watching. The time that this should happen would be sometime tomorrow. That's just based on the number of bars from the high on May the 1st to the low on May 8th, and the number of bars from the high on May 9th down to the low that we think is coming in on May the 14th. Whether this locks in with the stock market or not, you know, I'm not sure. But that's the bottom that I'm looking at. All I know is that if we go below 141 in the June Treasury bonds, that's going to trigger a lot of weekly things happening for people. And you know, we watch the notes too, because the notes are what, you know, these things are based on as far as the long-term interest rates that we have for our credit cards, and also for mortgages. And this also on the weekly basis has had a incredible head and shoulders pattern that you know, stopped you know, right at the exact 61% retracement, whereas the notes made the 61% retracement perfectly, but the Treasury bonds missed it by 6 ticks. I missed this too. I mean, I didn't see it to the day after, and by then the market had already broken quite a bit, and it never gave me a chance to get in. As I don't sell weakness very well, I've never been able to do that with any success at all, so I rather would wait to sell a little retracement pattern if it comes. And then we will get retracement patterns, because this has been a real bullish market, and there are going to be people that are non-believers. And, hey, I could be totally wrong on this one too. So we'll have to wait and see if this is going to be, you know, be at the top that I think it is. But, boy, you talk about a technical top that is really really shows some really tremendous technical price patterns that would take it down at least another 15 or 20% drop in Treasury bonds. And remember, this market's about 4 times the size of the stock market. That's just in the Treasuries. If you look at the corporate bond markets, you're looking at something that's even more ominous. And we've been mentioning the spreads between these things, for a very, very long time, and so that gives us an indication, of where we are with the, with the bonds. And I really think we've topped. I missed the first part of it, but I know we'll be able to get back into it the second part. But the main thing right now is the stock market. We're over what I think is a top for that's going to be very, very substantial. I feel as strongly about this as I did about the March of 2009 bottom when we had the the three drive to a bottom pattern. The Dow was trading at 6,400, and you couldn't get anybody to buy stocks. And we just had the biggest bank bailout of our financial markets in so long that it was really historical precedents that are happening all the time. Now, I need to talk a little bit about the U.S. dollar because we're having some really interesting things happening. We're back up to we've actually gone a little bit above the 786 again. This is the fifth or sixth time that we've hit this over the last few weeks. And we need the U.S. dollar index to get above the 84 level. It's trading around 83.50 something and change right now. So if it can get above the 84 level, that was telling us that we're breaking out, and that will take us to the old highs above 2010, which were right near the 89 level. So it could have a tremendous move. This would be equivalent to the euro, getting down into the 126, 125 level, and that's what we're looking at for this. So we'll have a pretty good idea. Someone asked a question about how much weight do I put on candles. I like candles, and the reason why is my eyes are not what they used to be 50 years ago when I first started looking at charts. So the candles are really easy to see, but I can get the same information, off of a bar chart. All I need is high, low, close, and open, and that'll give me a pretty good idea of where I stand. The patterns that you see with the candlesticks are really great, especially when you have these engulfing lines with tails and things like that and dojis. That's just telling you that things are slowing down, and that gives you a pretty good idea of entry points, because you got to be focusing on how much you're going to be risking, not how much you're going to be making. That's the real bottom line when you're watching these things trade. That's so the key number in the dollar is at the 84 level. It's a really, really big one. Last week we talked about the British pound up at the 156 level, that there was making a beautiful Gartley there, and that was at a 50% retracement of the high we made at the beginning of the year. It was a perfect ABCD, and now we're trading in below the 153, 152 and change level, and that looks like it's got a long way to go to the downside. The silver is still lagging the gold by a little bit, not by a great deal, but by a little bit. And it's enough that it gives our attention. Today, silver is actually up a bit, considering the gold has backed off. Now, I think gold, like I mentioned before, has some strong support between 14.25 and 14.18. It should have some good support there because of the 382 retracement. So, silver is really difficult to trade, folks, because it has pockets of illiquidity, and it has 1/6 the volatility, well, not 1/6 the volatility, but 1/6 of the volume that the gold has. There's more open interest in that, so that's why it's important, I think, from a trading point of view, is to trade the gold, as opposed to the silver. That's the bottom line of, the things that I think are important in the trading part of this. Now, I wanted to also bring up the chart on the Australian dollar. I put the long-term weekly in there along with John, so I will not go over that again. I think we feel pretty strongly that the Australian dollar should have strong support at this 99.50 to 99.70 level, and if that fails, it can go down to 97.45 without too much trouble at all. The main focus this week, in my opinion, is in the stock market, because if we put the top in today, and I'm not saying that we're going to, but if we do, then we have a chance of looking at something that would be a lot different. Now, we've got another market that we were involved in for quite a while. We got out of it way too early, but that's the function of trading. You're not going to get the whole move, that's for sure. But When the yen was down around that 75 level, the dollar versus the yen, it was making the three higher bottoms. The cycles were coming in. This was last August, and then we've had a tremendous move, and we actually made new highs this week. We went above the 102 level in the Japanese yen, which is a pretty big spot of looking at this yen. I think remember the yen in 1974, folks. The yen was at 280 to the dollar, and then went down to 75. So just a 382 retracement on this can take it to 125 to 140 without even batting an eye. That's another 40% from where we are here. So what we want to do is to look for a pullback. We had a really good one a few weeks ago at that 93 level that we talked about. This was about 6 or 7 weeks ago when we had the first really strong 382 retracement off the previous low, and since we just keep going higher and higher. So that's telling us that this market is got a lot of bias to the upside. That is also moving the Nikkei Dow. It's been going basically ballistic. Pretty much just like a perpendicular line for about 7 or 8 weeks now. And that market is extremely overbought. And those are the kind that get most people in trouble when they're looking at these things. To enter, they miss the first part of the move and then they chase it. And then I can tell you this, if I were to go long in the Nikkei, you could short it that way, because I'm probably the worst person in the world for chasing markets. That just does not, fit in with my style of trading or anything, anywhere even near it. So that's what just keep that in mind when we're watching it. I wanted to, someone asked the question again about the similarities between Apple and also the Treasury bonds that I posted, because I'm looking for the bonds to get down to the 143 level, about a 1.5 from where they are now. I'm going to put that a daily chart of Apple in there, to showing, how we came up with the price of 394 and the time of April the 15th. And so this is what we were we were looking for April 19th on Apple. That was the exact low, counting the number of days down, and the price level came in at 394, and of course it went to 385 early in the morning, and then since it's had a huge move, and we rallied up to the 786 level several times in this 460 area, which I think is going to give strong resistance, and then you'd look to be buying Apple if we backed off, say about 10%. If we backed off, down to the 417 level, that would really be a good buying opportunity in Apple. If that, in fact, works that way, and then we will have a better chance of looking at Apple that way. But the main thing that if I only got 10 minutes to go, I can take a little break. I'm going to post a chart here, and then when we get back, I'm going to spend the rest of the show just talking about this chart that I'm putting in on the Dow Jones monthly chart going back to 1999. What's actually happened in the stock market, and some of the timing aspects that are there, and why I think what we're over now is it's really tough. We got to take a break here. 877-927-6648.
Tom O'Brien's weekly newsletter, The Gold Report, has helped subscribers for over 10 years navigate the high-risk world of exploring and producing gold companies. And now's a great time to sign up for a free month-long trial to see the kind of insight that Tom delivers for his subscribers on a weekly basis. Every Monday, Tom O'Brien issues a quick update on the metal market, giving you his take on the HUI, XAU, GLD, dollar, bonds, and much more. Tom follows Monday's update with a full gold report, which is delivered to subscribers Tuesday afternoon with detailed coverage of 24 separate gold or metal stocks, as well as another 10 to 15 stocks that he lets you know are on his potential watch list. Get your month-long free trial to the Gold Report today by visiting the front page of TFNN.com. Don't spend another year navigating the metal markets on your own. Act early in 2013 and make the most of your gold and metal market investments.
with the launch of Tiger TV. TFNN has brought our programming to the next level. With Tiger TV, you can gain access to each host's charts and computer screens as they host their daily stock program. Whether it's Tom O'Brien, Steve Rhodes, Basil Chapman, David White, Larry Pesavento, Andy Hecht, Victor Jones, or Daryl Martin, you can catch all of our technicians hosting their programs live and archived on Tiger TV for your viewing pleasure 24 hours a day, 7 days a week. If you haven't checked out Tiger TV, then visit TFNN.com and see what you're missing.
David White's newsletter, The Technology Insider, is focused like a laser on finding the next big things in technology. If you had invested only $10,000 in Microsoft in 1986, you'd have been a millionaire by 2000. Disruptive technology like Microsoft's is the key to these massive long-term profits, and the Tech Insider is the vehicle from TFNN to capitalize on these opportunities. This is the go-to newsletter that identifies, monitors, and profits on mostly little-known cutting-edge companies with great long-term prospects. David's experience is as an inventor of Emmy-winning animation products for TV and Hollywood that propelled a company public. Match that with 14 years as a full-time trader, and he's uniquely qualified to guide you through the light-speed world of ever-evolving high-tech. If you're ready to ride the next big technology bull market for less than $40 per month, log on to TFNN.com and get your 2-week free trial to the Technology Insider. Get in on the ground floor of the next big thing today.
Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows, plus see all the charts as they happen live during those shows, and have access to all those charts. You can test drive the Tiger's Den, absolutely free for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com.
Are you looking for a precision edge in the market? Something that can stack the odds in your favor? Then look into Larry Pesavento's new trading newsletter, Patterns, Profits, and Peace of Mind. In each weekly issue, Larry explains what's going to happen in the markets based on the pattern he sees developing and gives you actionable trade ideas based on those patterns. Plus, you'll get his detailed analysis on a variety of markets and sectors, including stocks, treasury bonds, the gold market, oil, the dollar, the forex market, and more. And you'll get the Technical Corner segment, which is a short but powerful weekly training session on trading. You'll get access to all the patterns Larry is seeing in the markets, plus the Astro Harmonics and powerful Bradley stock market model that Larry utilizes for less than $5 a day. An extremely potent combination that will give you just the edge you've been looking for. Try Patterns, Profits, and Peace of Mind absolutely free for 2 weeks. Go to TFNN.com and click on the free trial link at the top of the page. That's an $85 value, yours free when you register right now. Get Larry's Patterns, Profits, and Peace of Mind and get the edge you've been looking for.
This segment is brought to you by TFNN. Test drive all the newsletters for free at TFNN.com.
Okay, boys and girls, let's have a fireside chat to end the show. I posted into Tiger TV the Dow Jones Industrial Average going back on a monthly basis to 1999, and it shows the 1, 2, 3, 4, 5 expanding triangles leading to a 3 drive to a top that what I believe we're experiencing right now. If you were to look at it on just the last 2 years, we also have another 3 drive to a top pattern coming together at the same time where we are right now. We are over what I think is one of the strongest astrological aspects we've had since March of 2009, and in August the 15th of 2007. It has the same equality as far as power. I don't know if this is going to turn it or not, but all I'm telling you, this is mother, God, and country. We watched Apple come down. I mean, this is no fundamentals. I don't know diddly squat about what the Fed is doing. I could care less. I'm looking at just technical indicators and looking at some timing things, and it tells us that, we're looking at something really sinister. We're seeing the same pattern all over the globe. We're seeing it in France. We're seeing it in Germany. We're seeing it in London. It's in the Dow Jones Transportations. It's in the Dow Jones Utilities. It's in the S&P 500, and it's also in the NASDAQ. So the pattern's there. Can it fail? Absolutely, it can fail. All I'm saying is be really careful up in here, because if it starts to turn, it's going to be very quick, and it could catch a lot of people by surprise, and they won't believe it. In March of 2000, I remember that very vividly. I was warning people that this was going to be something much greater than most people could fathom, and that's one of the reasons why I'm looking at it. The fact that Barron's came out this week with their headline of Dow 15,000 is pretty indicative of what people are thinking, and everybody is looking at much higher prices. But we'll have to let history decide whether this is going to be the way that it's going to be going right now. This is everything that a technician could ask for in a pattern. With this it's not just the Dow Jones; it's all of them. But they are there. They're completed. They've done what they wanted to, and I missed that the last few weeks up because I didn't see these longer-term patterns there. I didn't stay bearish the whole last 2 weeks, but today, is the day that I, take out the guns and, say this is where I'm playing, and we'll see how it ends up. The pattern is there. If you like technical analysis, it's got everything in a technical analytical chart that you could possibly ask for. It has the Fibonacci ratios, it has the patterns and expansions, and it's just an incredible array of events. And what's so amazing is that it's all over the globe. I mean, it'd be different if it was just one or two charts, but this is all over the globe, and that's what gives me a feeling that this is going to be something that's probably going to be life-changing. I don't know what it would be. I think higher interest rates look like they're on the board. I don't think there's any question about that anymore because of that head and shoulders pattern that we had. But we will see if the bonds are going to break the 141 level. They have to get to 143 first, and they're a point and a half away from that level. But there's a lot of complacency in the market that we see in the VIX index. All this adds up to the point where you got to be really careful in here, folks. And if you have 401ks and stuff, the simplest thing is what I talked about earlier in the day. Put your stop under last week's low, and that would be at around 14,500 in the Dow. That's about 170 or 80 points from where we are now. If we go below 14,000, or 280 points from where we are now, I would say that go and find a safe haven for your assets, for your money assets. Anyway, listen, live every day in an attitude of gratitude, and may God bless.
Let me tell you something, folks. I have people coming up to me saying, I just can't believe the amount of work that Steve does on his newsletter. And I says, I absolutely agree.
That is a recent clip from the Money Masters show that Tom and I do each day at TFNN. My newsletter service, Mastering Probability, is much more than a newsletter. Yes, it's outperformed the S&P 500 by 100% during the last 15 months. But more importantly, it's an extraordinary education, a roadmap for your success. And it's yours risk-free for the next 30 days. Just go to the homepage of TFNN.com and click on my name, Steve Rhodes, and then Mastering Probability, because everyone needs a success strategy. For most, it's a competitive edge, the will to win, the drive to overcome any obstacle. Whatever you call it, winners find a way. Find your way to Mastering Probability today, because your journey to extraordinary rewards is just one click away.